Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The forced break higher back in late August over the top of the diamond pattern, which I had highlighted in blue, formed over November 2021 to July 2022, started a move, admittedly initially in the wrong direction at the time, that has eventually led us to where we are now today. The pipe top formed on the 9th and 12th of September were the direct triggers for the start lower. The actual pattern, the lopsided diamond, is huge. I had in my previous commentaries given a primary target X in the 166 and 3/4 area, whilst a secondary harder to achieve target X1 would be in the 142.40 area, which is currently below the bottom of my daily chart. I said at the time, and I quote, "Needless to say, given the size of the lopsided diamond pattern, these proposed targets below, assuming the break lower holds, are some longer term targets." End of quote. I also continued, and I again quote, "There is one other fly in the ointment. Perhaps, just perhaps, this lopsided diamond pattern is becoming a big bear channel. If that was to be the case, then the first area to look at below would be the lower bear channel line of such a pattern. That's currently at 173.60. And that's the end of the quote. The extension of the bear channel you can see highlighted in green. The lower bear channel line, though breached last week and the week before, was only really broken after numerous attempts that went to a third level of indecision, with a second consecutive close below 2 Fridays ago. In part, this was due to support from the 50% Fibonacci line of the May 2019 to February 2022 move at 174. But I suspect more so from the neckline highlighted in red below of the January 2020 to April 2021 reverse head and shoulders bottom, currently at 167 even. It was only on Monday last week that prices finally smashed down through the primary target for the diamond pattern at 166 and 3/4. Now, we have started to see some stabilization below the neckline, which was countered last Thursday by a key reversal up that closed back up over the neckline. However, last Friday's action was an indecisive spinning top sitting right on top of the neckline, which indicated that perhaps, just perhaps, the follow-on to the key reversal up was perhaps a weaker than it looked. Today we've seen the immediate follow-on to that with a dip below the neckline again, but also a move back up again. The market needs to find out what it wants to do with this neckline. If, as I still suspect, we see prices come under pressure again, then we will need to look lower for support at the 2017 high at 159.30 and the August 2017 high at 147.25, and possibly down to target X1 in the 142.40 zone. This is why what happens at this neckline is so crucial. London coffee. There are two relevant features here in the recent past in relation to the fall in this market. The first was early on. It was the early August until late September type of head and shoulders pattern. The neckline, currently at 21.29 and highlighted in green, was breached and then properly broken, and since then the market has broken down through the following. All the following remaining moving averages. The 50% Fibonacci line of the August to December 2021 move at 2064. The middle time, currently 2017 and highlighted in blue, of the late December 2021 to mid-July 2022 bearish Andrews pitchfork. The significant congestion zone split into a number of individual bands as between 1968 to 2004. The congestion at 1945. The 2018 high at 1845, and finally slowing and halting just ahead of the 50% Fibonacci line of the October 2020 to December 2021 move at 1812 2 weeks ago. During the move lower, a new pattern emerged, highlighted with red trend lines on my daily chart. To give you an explanation of this pattern, I would like to refer you to my commentary from about a month ago, and I quote, "It was whilst I was studying this supposed neckline that I saw another clearer pattern that was a better fit for the recent action. I've highlighted a pattern in a thicker red color so it becomes more obvious. It is a late August to date falling wedge pattern, currently 2040 to 2072. This pattern is a very reasonable fit for the action, and it has a requisite number of touches per side to qualify as a mature pattern. The question is whether the market will follow through. I cannot give a definitive target in either direction for this pattern, but I can give a primary size of the move should either one of the two trend lines above and below be broken. A primary move higher would be right now something in the order of $145 on top of the break of the upper trend line, whilst a break lower would be something like $68 off of the break of the lower trend line. This is one to watch. End of quote. I later made an assumption that the break lower below the falling wedge pattern itself was a genuine break. It's quite an assumption, but I did. Thus giving a primary target X1 in the 1957 area, and a secondary target, the harder to reach target X2, in the 1870 area. 3 weeks ago, both target X1 and target X2 were reached. So what happens now? Well, it seemed that we had maybe three possible avenues. The first was to look at the 50% Fibonacci line at 1812 and the nearby lower time, currently 1773, as the end of the current move lower, leading to some possible consolidation before a possible attempt up towards the congestion overhead, starting at 1945. Alternatively, it could be that we are seeing some consolidation here, even possibly as high as the 1945 area, before the market again turns back down with a possible bear flag, bear halfway hesitation type pattern, and with potential down to possibly as far as 1670 zone. This is by no means a done deal, but is worth considering. There was a third solution, and it only started to become considered because of the specific actions made 2 weeks ago. It was to consider, just consider mind you, that we're making a nascent possible diamond pattern. Well, this week, this last idea I have rejected, but the other two avenues, the first two avenues, well, they are still on the block. But I think the market still hasn't made up its mind on which it may wish to follow. You see, just take last week and the week before's action. In that we have two definitive indecisive spinning tops and two others that may at a pinch be considered indecisive spinning tops. This denotes up to 40% of the time the market is exhibiting intra-day indecision. Add to this immediate countering actions which have gone out to the fourth level, and you can add another 40% odd as inter-day indecisive actions. So you see, the action around the lower time is not settled as to whether the prices rise to only fall later, perhaps, or to fall away straight away. What happens at the lower time will, I suspect, become crucial. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.